Congratulations for taking another important step on your journey to becoming a master investor. You've gone through the basics of options and learned how to build wealth using the stock replacement strategy. Now it's time to take it up a notch and see how options can help you achieve the other three goals you can have as an investor. Hi, I'm Costas Bocelli, and joining me is Chris Rowe, the co-creator of Option Soup.
Hey there, Chris. Hey, how's it going? Thanks, Costas. First of all, I want to thank you for trusting us with your options investing education. We take education very seriously here at True Market Insiders, and we love to train investors. Option Soup was created to give you an easy-to-learn, comprehensive program that teaches you everything that you need to know about how to manage your investments in any market environment. As Costas mentioned, with the stock replacement strategy, you'll already learn an effective and less risky way to grow your wealth. But growing wealth is just one of four main goals that you can have as an investor. There are three others. You can speculate to earn high returns quickly, you can generate income, and you can look to preserve your wealth that you already have. In the advanced portion of Option Soup, you're going to discover some easy-to-use option strategies that help you achieve each and every one of those goals. But first, let's dive deeper into the price behavior of options and what ultimately makes them tick. Costas, tell us what you're about to lay out.
Sure, Chris. We're going to have a discussion on the Greeks, or the risk sensitivities associated with options investing. Understanding the Greeks can be complicated, even intimidating for the average investor, and I get that. So I'm going to walk you through the Greeks in a way that will make sense and give you a practical understanding of how to use each of them. I'm going to share all of my knowledge from the time I was a professional floor trader. I'm going to take a complicated subject and teach it in a way that's very easy to understand.
Kind of like revealing your own personal cliff notes on everything that you've learned over all these years, right, Costas?
That's right, Chris. It's going to be valuable information delivered in a way that's super easy to follow. So let's get started with what you need to know about the Greeks. In this lesson, we're going to discuss the Greeks. We've already seen that our options pricing model contains 5 inputs, and that we can feed each one into the model to solve for the theoretical value of an option. Our 5 inputs are the current price of the underlying stock or ETF, the option strike price, the option expiration date, the statistical implied volatility, and the carry cost, which is a risk-free interest rate and dividends. For example, we can open the Option Soup calculator found under the Tools tab to solve for a particular options value using the proprietary pricing model that comes with your subscription. As you can see in this graphic, we're calculating the option values in a particular series in Apple, symbol AAPL. With Apple trading $190.80, the Apple August 190 strike call option is worth $7.56, and the corresponding Apple August 190 strike put option is worth $6.55. These option values are highlighted in yellow. The values also happen to be static. In other words, these option values are dependent on the exact inputs that we fed into the pricing model. Well, what happens to the price of the options as the input values change? Consider all the things that can impact the value of an option: a change in the price of the underlying stock or ETF, the continuous movement in time, a change in implied volatility, and changes in the carry cost considerations, such as interest rates and dividends. As you can see, there are a lot of moving parts that can alter the value of an option. The good news is that we can rely on the Greeks to help us measure the different factors that affect the price of an option. And having a good understanding of the Greeks can help an option investor make more informed decisions about which options make the most sense to trade and when to trade them. You should already be familiar with the first Greek, delta, which we covered extensively in Lesson 4. If you recall, delta is a measure of how much an option's value is expected to change with respect to a $1 change in the price of the underlying stock or ETF. But there are other Greeks that you need to be aware of to cement your overall understanding of the price behavior of options. The other Greek sensitivities that we'll be discussing include gamma, theta, vega, and rho. If we refer back to the Apple example in our Option Soup calculator, we'll find the values associated for all 5 Greeks located below the option values. As you can see from the example, the delta of the call option is 55, and the delta of the put option is negative 46. So for a $1 move in the price of Apple stock, the call option should change in value by approximately 55 cents, and the put option should change in value by approximately 46 cents. And below the delta, you see the other Greeks, gamma, theta, vega, and rho, which we're going to cover in this lesson. You can also access the Greeks by entering a stock symbol on the Option Soup platform. Simply enter the symbol and click on the Option Information tab. You should already be familiar with this section on the Option Soup website portal. This is the same place where you can access the options chain information and the valuable volatility tools that were discussed in Lesson 4. As you can see, all the Greeks and their corresponding values are located next to the implied volatility column. I encourage you to take advantage of the Option Soup platform and all the tools that come with your Option Soup subscription. They're designed to be a valuable resource for you. Learning about the Greeks can seem a little intimidating. Option pricing is based on calculus mathematics, not exactly the easiest subject to grasp. Trust me, I found this out firsthand when I trained to become an equity options floor trader on the Philly Exchange in the late 1990s. After clerking for the senior traders by day, I was put through a rigorous training program at night. It was fast-paced and intense. This was intentional. The firm's executives needed to separate the ones who could swim from the ones who would sink in high-pressure situations. Fortunately for me, I turned out to be a very good swimmer during the 7 years I spent trading in the options space. And what kept me buoyant was mastering the Greeks. But don't worry, this lesson won't be nearly as intense as what I had to undergo. But it will be just as valuable. You see, I'm going to take everything I learned about the Greeks and give you the Option Soup condensed version. That means we're going to clear away all the mathematical theory and wonky equations and discuss the Greeks in a practical, common-sense manner. In other words, you'll walk away with a good understanding of how the Greeks work from the perspective of an individual retail investor. With that in mind, let's begin with a little more to say about delta. So far, we've defined delta as a measure of how an option's value changes with respect to a $1 change in the price of the underlying stock or ETF. But there are other interpretations of delta. For professional options traders, delta also serves as a hedge ratio, which is essential for managing risk and trading volatility. Aside from trying to profit from the bid-ask spread, market makers and professional options traders can also profit by trading volatility. Through a special exemption by the Federal Reserve known as Regulation T, the rules governing professional broker-dealer accounts are vastly different than those governing retail customer accounts. This difference basically makes trading volatility in a customer account prohibitive. So there's no need to discuss that particular interpretation of delta. But there is another interpretation of delta that can be useful to the individual options investor. If we ignore the sign of the delta, positive for calls and negative for puts, delta is approximately equal to the probability that the option will finish in the money. For example, a call option with a delta of 30 or a put option with a delta of negative 30 has about a 30% chance of finishing in the money. A call option with a delta of 80 or a put option with a delta of negative 80 has about an 80% chance of finishing in the money. As an option's delta moves closer to 100 or negative 100 for the puts, the option becomes more likely to finish in the money. This is why at-the-money options have deltas close to 50 or negative 50 in the case of the puts. Keep in mind that this interpretation of delta, the percentage chance the option will finish in the money, does not tell us by how much the option might finish in the money, nor does it indicate whether or not the option will generate a profit. The delta value is derived by the inputs of the options pricing model, so it's important to view it for what it is, a tool to help you make informed decisions. Interpreting delta as a percentage chance of finishing in the money can help you choose which option to target for a particular option strategy. In Lesson 5, we discussed the stock replacement strategy, which targets an option with an initial delta of 80 or negative 80 for the puts. Please note, for simplicity during our discussion, from now on, I'm only going to refer to positive delta, but do keep in mind that for puts, the delta would be negative. We know that the price of this option has a high correlation to the movement of the price of the underlying stock. And we now know that this option has a high probability of finishing in the money, even though we would never carry this option all the way to expiration. Viewing delta through the lens of an option's finishing in the money is a lot like knowing the point spread of a football game before the game is played. It's simply another layer of information to help you make better decisions. Before we move on to the next Greek, here's one more observation regarding the behavior of delta. As you should be aware by now, at expiration, an option is either worth something, it has intrinsic value, or worth nothing, it finishes out of the money. So at the very last second before the option expires, the option will either have a delta of 100 or 0 if it's out of the money, having no intrinsic or extrinsic value. At expiration, there is no other value. It's simply one or the other. But as we increase the time to expiration, you'll notice that the option deltas will begin to crunch towards 50. In other words, options that carry a high delta, meaning that the ones that are in the money, will converge down towards 50. And the options that carry a low delta, the ones that are out of the money, will converge up towards 50. This is also true as we increase the implied volatility of the option. If implied volatility increases, we know that the option will become more expensive, as the market is anticipating bigger price movements in the underlying stock or ETF. So when implied volatility increases, there is a greater likelihood that in-the-money options will finish out of the money. And there is a greater likelihood that out-of-the-money options will finish in the money. And because of this, the deltas begin to become more at the money, with call deltas approaching 50 and put deltas approaching negative 50. This was a very important concept to grasp when I was training to become a floor trader. My mentor used to compare the changing values of delta with respect to changes in time and volatility to the shape of a trumpet. He came up with the term trumpification to describe the effects of time and volatility have on the option deltas. This was his way of burning in our minds how option deltas behave with respect to the changes in time and volatility. I actually saved my original notes after all these years, around 1998, on the delta lesson. Have a look. The page from my notebook shows two graphs that visualize the effect that time and volatility has on delta. The top graph shows the effect of time. As time increases, the deltas begin to crunch towards 50. The bottom graph shows the effect of implied volatility. As volatility increases, the deltas begin to crunch towards 50. The drawings resemble the shape of a trumpet, don't they? By the way, the delta effect works in the opposite direction too. Should be decrease time to expiration and decrease the implied volatility. In this case, all option deltas move away from 50 and towards 100. The delta effect is a key foundational concept to understanding how options work in the real world. Okay, now let's move on and discuss gamma. Gamma measures the rate at which an option's delta changes as the price of the underlying stock or ETF changes. Gamma is usually expressed in deltas gained or lost per a 1 point or a $1 change in the underlying stock or ETF. So you can think of gamma as being the delta of the delta, or the second derivative of the option's value. If you remember from our discussion of the stock replacement strategy, we target the option that has a starting delta in the range of 75 to 80 for the calls and negative 75 to negative 80 for the puts. But as you know, the delta value is sensitive to change as the price of the underlying stock fluctuates. That change in the delta is reflected by the gamma. Here's what you need to know about gamma. Call options and put options both have positive gammas. This is different from the deltas, where you'll recall call option deltas are positive numbers and put option deltas are negative. But regardless of whether we're looking at calls or puts, we always add the gamma to the old delta as the underlying rises and subtract the gamma from the old delta as the underlying falls. If you buy an option, either a call or a put, you're considered to have a positive gamma position. And if you sell an option, either a call or a put, you're considered to have a negative gamma position. Now let's run through an example of how gamma works. Have a look at this screen from the option soup calculator. We are looking at a particular option series in Visa with a strike price of 135 and a September expiration, which in this example happens to be 91 days out. In this example, the stock price is 134.53, highlighted in yellow. So the options we are looking at are considered at the money. On the right, you see the theoretical values of the call option, $5.24, and for the put option, $5.21, based on the model inputs that are on the left. Below the option values, you'll find the Greeks. Let's start with the call option. It has a positive delta of 52, shown by the blue arrow. Now notice the gamma, highlighted in the red rectangular box just below the delta value. The call gamma is 0.0307, or if we round it, 0.03. In the option pricing model, gamma, like delta, is expressed as a decimal. So make sure you move the decimal 2 places to the right to ensure you're comparing apples to apples. So in this case, the delta is 52 and the gamma is 3. Here's what that means. Say the price of Visa stock rises 1 point to 135.53. We then add the gamma of 3 to the call delta of 52 to get the new delta of 55. Essentially, the rise in the stock price has increased the sensitivity of the delta, which is good for a call buyer. A positive gamma helps option buyers. Now, what if the price of Visa stock falls 1 point instead to 133.53? In this case, we would subtract the gamma of 3 from the call delta of 52 to get the new delta of 49. In this instance, the fall in the stock price has decreased the sensitivity of the delta, which if you think about it, is also good for the call buyer, but in a slightly different way. You may be thinking, but Costas, don't we generally lose money owning a call option when the stock price declines? And you'd be correct. But with the decline in the stock price, we get a decline in the delta as well. In other words, when you own a call option, deltas rise when the stock price rises and deltas fall when the stock price falls, which means the call option allows you to make more money when you're right and lose less money when you're wrong. Both scenarios are actually good outcomes relative to taking a direct position in the underlying security. Are you beginning to see how options can make investing less risky than trading directly in the stocks and ETFs? We see this at work with the stock replacement strategy. Because as option buyers, we also have a positive gamma position, so the math is working in our favor with respect to the movement in the price of the underlying stock or ETF. This is also true for put options. Let's refer back to the screenshot of Visa. As you can see, the put option has a delta of negative 48, highlighted again by the blue arrow. Now notice the gamma, again highlighted in the red rectangular box. It also has a positive gamma of 0.0313, or 0.03 if we round 2 decimal places. Moving the decimal point 2 places to the right gives us 3. This means that if the price of Visa stock falls 1 point to 133.53, then we subtract the gamma of 3 from the put delta of negative 48 to get the new delta of negative 51. Essentially, the fall in the stock price has also increased the sensitivity of the delta, which is good for a put buyer. The positive gamma has resulted in the put delta becoming even more negative, which is a good outcome, wouldn't you say? As a side note, if working with negative numbers is a bit confusing, this graphic might help. I did promise to leave out all the wonky calculus, but if you can think back to any of your earlier math classes where you learned how to count numbers, even the negative ones, using number line graphs, you'll catch up real fast. Okay, now what if the price of Visa stock gains 1 point instead to 135.53? Well, in this case, we would add the gamma of 3 to the put delta of negative 48 to get the new delta of negative 45. In this instance, the rise in the stock price has decreased the sensitivity of the delta, which if you think about it, is also good for the put buyer. Yes, it's true that the rise in the stock price is not a desirable outcome for the put option buyer, but with the rise in the stock price, the delta has become less negative. It moved from negative 48 to negative 45. In other words, when you own a put option, much like owning a call option, you'll make more money when you're right and lose less money when you're wrong. Both scenarios are actually good outcomes relative to taking a direct position in the underlying stock or ETF. So when you're a buyer of an option, the movement in the price of the underlying stock or ETF is helpful with regard to the delta of the option, even when the move in the price goes in the wrong direction. That's a huge benefit of being an option buyer and having positive gamma. It's also worth noting that calls and puts with the same exercise price and the same expiration date will both have similar gamma values. In both examples in Visa, the call gamma and the put gamma were not only both positive, but both had a similar value, very close to 3. This is no coincidence. You'll find it to be true across most series of options you encounter. Another observation is that gamma is more sensitive in smaller price stocks than higher price stocks. That is, options with lower strike prices have higher gamma values than do options with higher strike prices. For example, gamma values associated with a stock trading at $15 per share will be higher than in a stock trading $280 per share. And the last point on gamma that you need to be aware of is that gamma will be highest for an option which is at the money and nearest to expiration. The gamma becomes progressively smaller as an option moves either deeper into or out of the money. Typically, speculators will reach for near-term at-the-money options because these are the ones most sensitive to the price movement in the underlying, which is largely reflected by delta and gamma. All right, now that we've covered gamma, let's now turn our attention to theta. The theta, or time decay factor, describes the rate at which an option loses value as time passes. Theta is expressed as the value of the option lost per calendar day. Theta also has an inverse relationship to gamma, which means that both calls and puts have negative thetas. Since an option has a limited lifespan and time runs in only one direction, the extrinsic portion of the option continuously decays. Options that carry a higher volatility decay at a quicker rate than lower volatility options because there is more premium or extrinsic value priced into the option. Regardless of the implied volatility of the option, we can rely on theta to measure the daily rate of decay on the option's value. If we refer to our example using the option series in Visa, you'll see the thetas for both the calls and the puts located just below the gammas, highlighted in the red rectangular box. As you can see, the theta of the call option is negative 0.0327, or negative 0.03 if we round to the second decimal point. Theta is expressed in dollars and cents, similar to the value of the option. This means that the Visa call option with a theta of negative 0.03 will decay in value at a rate of 3 cents per day. So if we assume all the other inputs, such as the price of the stock or the implied volatility, remain the same, the call option will decline in value from $5.24 to $5.21, or about 3 cents after the passage of one day. And as for the put option, you can see that the theta is negative 0.0247, or negative 0.02 cents if we round down to the nearest penny. So again, if all the other inputs in the pricing model remain the same, the put option will decline in value from $5.20 to about $5.18, or about 2 cents by the next day. Now that you know how to measure the time decay of an option, here are some more insights on theta. We mentioned that gamma and theta had an inverse relationship, meaning gammas have positive values and thetas have negative values. This also reveals a fundamental fact of options investing, which is that every option position presents a trade-off between the market movement and time decay. If price movement in the underlying stock or ETF benefits an options buyer, has positive gamma, then that must mean the passage of time works to his detriment, has negative theta. So anytime you're a buyer of options, calls, or puts, you're considered to have a negative theta position. The passage of time is always working against you. If you're a seller of options, on the other hand, calls or puts, you're considered to have a positive theta position. The passage of time is always working in your favor. You'll also find that, just like with gamma, theta will be highest for an option which is at the money and nearest to expiration. Options that move deeper in the money or further out of the money will have less theta. This makes sense because, as we learned in earlier lessons, the at-the-money options are the ones with the most extrinsic value, and therefore susceptible to the greatest amount of time decay. And from our discussion in Lesson 5 on the stock replacement strategy, we know that as we get closer to expiration, the rate at which an option decays begins to accelerate. Recall this illustration from Lesson 5. We highlighted the rollout trade adjustment window of within 60 to 30 days from expiration as a tactic to mitigate the impact of time decay on the value of the stock replacement strategy option. We advise rolling the stock replacement strategy option around the 60 to 30 day expiration window because that's when time decay begins to accelerate, something which is reflected by an increase in the theta value. This also speaks to why we initially target an option that's in the money, having a delta of 75 to 80, and has 6 months to expiration. The reason is that this option is the one that carries a relatively low theta with respect to the purchase price of the option. In an upcoming lesson, we're going to discuss how to generate income with options. As you'll see, the income strategy takes a very different approach than the stock replacement strategy. Since generating income entails being a seller of options, and since the option sellers have positive theta positions, and thus benefit from the acceleration of time decay, we will actually approach the rollout window with a completely different mindset. So when we're sellers of options, our focus will turn to initiating positions in the front months of an options board. Now, let's move on to Vega, the volatility factor. Here's a quick story from my early days as a market maker on the Philly Options Exchange. In the roaring 1990s, Dell Computer was not only the hottest technology stock on Wall Street, but it also happened to be the most actively traded equity options class in the United States. And before the listing wars broke out around the year 2000, options on Dell were exclusively listed on the Philly Exchange, meaning that every options trade had to be executed on the PhilEx. At that time, Dell was also one of the most popular stocks to speculate with using call options. Investors were enamored with the massive returns that could be generated speculating in Dell options. You see, Dell was a high flyer in its heyday. The stock would go up, then split, then go up again, and split again. If memory serves, Dell stock split 3 times in the span of a single year. As you might recall, this was also around the time of the infamous dot-com internet technology bubble. Every time earnings season rolled around, you could feel the excitement brewing. Thousands of contracts were wagered in the options market, many using relatively cheap out-of-the-money call options. That was how the retail options investors mostly played Dell's earnings. But here's the thing that more often than not burned a lot of those investors. While Dell would usually deliver a strong earnings beat and the stock would usually react positively, those call options that the retail public were buying, although nominally cheap in price, were incredibly expensive based on the implied volatility of the options. And like clockwork, once those earnings results were released and the market opened, the option premiums, the extrinsic portion of the options, would instantly collapse. Floor traders refer to this scenario as a volatility crush. In other words, while retail speculators have gotten the direction right, the drastic decline in the implied volatility of the option more than offset the gains from the price move in the stock. This left speculators scratching their heads as to why the call option lost money. This speaks to the risks inherent in a change in volatility. If you recall in Lesson 4, we discussed how we can use the implied volatility of an option to gauge how expensive it is relative to the historical implied volatility over the past 52 weeks. The option suit volatility tools that are included with your subscription are a valuable resource for analyzing the implied volatility of the options. Here's another snapshot of a historical volatility chart, only this time we're looking at the implied volatility of the 30-day options in Netflix, symbol NFLX. As you can see, circled in green, in early June implied volatility was 25%, near the low end of the range. This tells us that options in Netflix were considered relatively cheap over the past year, right? Now look at where implied volatility was in late June. After the passage of just a few weeks, it has increased dramatically to around 60% in that red circle. In other words, options in Netflix are relatively very expensive. In fact, they are the most expensive they've been over the past 52 weeks, based on the volatility historical data. Why is this? The answer is for exactly the same reasons that options in Dell Computer were so expensive more than 20 years ago. There's a huge amount of investor interest in Netflix, and so the demand for options is exploding in anticipation of the earnings event. Netflix typically reports earnings a couple of weeks after the end of each calendar quarter. Investors have bid up prices so much in anticipation of a big price move in the stock that the options carry a high degree of volatility risk. If you refer back to the chart, every spike in volatility is followed by a precipitous fall, the post-earnings volatility crush that I referred to a moment ago. Option traders should be fully aware of the volatility risk before entering into any options trade. One way to quantify the risks associated with changes in volatility is through the Greek sensitivity metric, Vega. Although Vega is technically not a letter in the Greek alphabet, option traders call volatility risk Vega, so be that as it may. Vega measures the change in the options price for a 1% change in the implied volatility of the option. For options trader, 1% equals 1 volatility tick. So if implied volatility were to increase from 40% to 45%, then the implied volatility increased by 5 ticks. The Vega of an option is expressed in dollars and cents, which represents the change in the option's value with respect to 1 volatility tick. Since all options gain value with rising volatility, the Vega for both calls and puts is positive. In our example, using the option series in Visa, you'll see the Vegas for both the calls and the puts just below the thetas, highlighted in the red rectangular box. As you can see, the Vega of the call option is 0.2675, or 0.27 if we round it to the second decimal point. Since Vegas, like thetas, are expressed in dollars and cents, similar to the value of the options, this means that the call option will increase in value by 27 cents for every 1 tick increase in volatility. On the left side of the options calculator are the inputs to the pricing model. Notice the implied volatility is 19.4%, highlighted in the black rectangular box. If implied volatility were to increase 3 ticks to 22.4%, then the call option would increase in value by approximately 81 cents. 3 times 27 cents equals 81 cents. This means the call option would increase in value from 5.24 to 6.05. It works the other way too. Each tick lower in implied volatility should reduce the value of the call option by 27 cents. If implied volatility were to decrease 3 ticks, say to 16.4%, the call option would decrease in value by 81 cents. So the call option would decline in value from $5.24 to approximately $4.43. Same goes for the puts. As you can see, the vega of the put option is also 27 cents, rounded to the nearest cent. This is no coincidence. You'll find that the vegas of the corresponding calls and puts, meaning options with the same strike price and the same expiration date, will have similar values. If implied volatility were to increase 2 ticks to 21.4%, then the put option would increase in value by 54 cents, which means the put option would increase in value from $5.20 to $5.74. And if implied volatility were to decrease 2 ticks to 17.4%, then the put option would decrease in value by 54 cents. So the put option would decline in value from $5.20 to $4.66. Now you know how to measure volatility risk in the option. Here's some more insights on vega. We know that vega, similar to gamma, is positive for calls and puts both. That means if you're a buyer of options, calls, or puts, you have a positive vega position. Increase in volatility benefits buyers of options. It also means that if you're a seller of options, calls, or puts, you have a negative vega position. When you're a seller of options, a decrease in volatility is preferred. Vega is also highest in at-the-money strike options, just like gamma. As the option moves deeper in the money or further out of the money, the vega sensitivity decreases. But there's a clear distinction between gamma and vega sensitivities with respect to the amount of time to expiration. As we discussed with gamma, it's most sensitive in the near-term expiration cycles. But with respect to vega, it's the opposite. Vega is most sensitive as the option moves further out in time. For example, a 4-month option will have a greater vega and therefore be more sensitive to a change in volatility than a 1-month option. Okay, now let's briefly discuss rho, an option sensitivity to a change in interest rates. Of all the Greeks, rho is the least important for the typical individual investor trading in a customer account. In fact, when contemplating an options trade, the implications of the change in interest rates should really never enter into the equation. That said, we're going to offer some insights on rho since it will complete our foundational understanding of the price behavior of options. Rho measures the expected change in an option's price for a 1% or 100 basis points change in interest rates. When trading US-based equity options, the interest rate consideration is the risk-free rate that an investor can earn from holding US Treasury securities across the duration of the yield curve. For example, if you're trading an option that has 3 months to expiration, then the interest rate consideration should closely follow the path of the yield on a 3-month US Treasury bill. Likewise, if you're trading an option with a longer duration, such as a LEAP, then the interest rate consideration would likely be focused on the trajectory of the yield you can earn in a 2-year US Treasury note. For large institutions and floor traders, rho is certainly a risk that needs to be managed, since the positions can be massive enough that changes in interest rates can have a significant impact. The larger the position, the more risk exposure with respect to changes in interest rates. But for the typical retail investor, changes in interest rates ultimately have a minimal impact on the profitability or success on any given options trade. Once we run through an example, you'll see what I mean. Let's refer to the example using the option series in Visa, where you'll find the rho values highlighted in the red rectangular box. As you can see, the rho of the call option is 0.1645, and the rho of the put option is negative 0.1429. Right off the bat, we can infer a couple of things. First, the mathematical signs are different, like the option deltas of the call and the corresponding put. Call options have positive rho, and put options have negative rho. Also, the values are different, which will require a very deep mathematical explanation on probability theory, the potential for early exercise, and the complex math involved in the pricing models. We'll gladly skip over that. But here's the point on interest rate risk from a practical perspective. Let's look at the calls, which are worth $5.24 and carry 91 days to expiration. On the left side of the options calculator, you'll find the risk-free interest rate on the expected yield for a 3-month T-bill, which matches closely the 3-month life of the option. In this example, it's 2.27%. What rho tells us is the change in the value of the option should the interest rate rise or fall by 100 basis points within the next 3 months. In other words, should the Federal Reserve adjust short-term interest rates by 100 basis points, that's equivalent to 4 25 basis point policy moves over the next couple of months. It could cause the call option to rise by 16 cents, from $5.24 to $5.40. Or if the Fed were to slash interest rates by 100 basis points, it would cause the call option to decline by 16 cents, from $5.24 to $5.08. Now think about that for a moment. What are the chances that the Fed is going to move on short-term interest rates 4 times in the next 3 months? You can count on one hand the number of times the Fed has moved 25 basis points incrementally on interest rate policy since the stock market bottom in 2009. It's 5 25 basis point adjustments in nearly a decade. In other words, changes in interest rates affecting the retail investor will have a negligible impact on options trades. Although I'm telling you to pretty much ignore interest rate risk, it is important for you to understand the impact of changes in interest rates. So with this example, you can see that call options increase in value as interest rate expectations rise, and decrease in value as interest rate expectations fall. For this reason, calls have positive rho. That means that put options decrease in value as interest rate expectations rise, and increase in value when interest rate expectations fall. For this, puts have negative rho. Rho sensitivity is also greatest far out in time and for options that are deep in the money. So for calls, rho is most sensitive in the lower strike prices, and for puts, it's most sensitive in the higher strike prices, generally speaking. So there you have it, Costas' option soup condensed version on the Greeks. I'll see you in the next lesson.
That's great stuff, Costas. And I love how you took such a complicated subject like the Greeks, with all the math involved with it, and presented it in such a simple way.
Thanks, Chris. Okay, now that you've gone through everything that can affect an options price, let's talk more about those other goals and the appropriate option strategies that go along with them. In our next lesson, we're going to discuss how to speculate with options.
This is the goal that gets lots of attention from the financial media.
Yeah, that's right. This is the alpine ski jumping of the investing world. It's thrilling, yet also risky. But here's the thing. Something that's perceived to be very dangerous, such as risking 100% of an investment, is far safer than you might think, if you take the time to learn it the right way. In that sense, we're going to show you how to speculate with options in order to generate large profit returns and quickly. And do it in such a way that if you happen to wipe out, you'll easily be able to get right back up, dust yourself off, and try again.
Now that sounds like a great way to score big gains safely.
Absolutely.